Welcome viewers to yet another scintillating session of our critique of world economics, where we slice through the economic waffle, cut the government PR spin, and expose the true cost of all the brilliant leadership we're being fed, whether it's the UK, Europe, or beyond. Today's topic, Britain, its European counterparts, and the contested crown four biggest economic disappointments of the next 15 years, because let's be clear, what's promised rarely materializes. Buckle up. The Centre for Economics and Business Research, CEBR, has laid out its long-term projections, boasting that the UK's economy will outperform its European neighbours in the next 15 years. Prime Minister Keir Starmer has seized this so-called optimistic report like a drowning man clutching a lifebuoy. According to their findings, Britain will hold on to its rank as the sixth largest economy by 2039, ahead of France, Germany, and Italy. But, before we pop the champagne, it's worth pulling up the curtains to scrutinise this forecast properly. Folks, this is no economic miracle in the making, it's simply a game of relativity. The UK's outperformance is not due to its stellar growth or persuasive economic reforms, but rather the comparative gloom of its Eurozone neighbours. Can we really celebrate being the least worst performer? What we're seeing here is the classic political tactic of distraction. Look over there, they're doing worse than we are. But does that make Britain an economic success? Hardly. Let's start with the first issue: why is Britain's projected outperformance essentially meaningless? The answer is simple: it reflects Eurozone stagnation, not UK greatness. The UK is only narrowing the gap with Germany in the next 15 years because Germany itself is facing some severe structural problems, both demographically and industrially. As of 2023, Germany's economy was 31% bigger than the UK's. By 2039, it's forecasted to be just 20% larger. On paper, that looks like a win, right? Not quite. This slowing growth among Europe's top players, especially Germany, isn't a reflection of any UK excellence, it's the product of a deep-rooted crisis within the Eurozone itself. Just look at Germany's over-reliance on aging industries like automobiles, which are struggling to adapt to new, greener technologies. And remember Berlin's disastrous dependence on Russian energy. Yes folks, that one misstep has sent shockwaves through Germany's entire economy. Yet, in response, the UK government has done extraordinarily little to capitalize on these geopolitical changes. The British growth rate remains tepid, hovering around a forecasted 1.8% in the long term, which is less than inspiring when compared to real emerging market breakouts. Some would call this an economic Lazarus, rising from the abyss, when in fact it's barely limping ahead. Prime Minister Starmer's manifesto is full of bold promises, a blitz of planning reforms, boosted house building, and doubled public investment. Yes, on the surface, it sounds like the deus ex machina that Brits have been waiting for. But let's bring it back to reality. Labour's current track record hasn't delivered tangible results, and the economy has stagnated since they took office in July 2024. And let's not kid ourselves, the biggest hurdle here isn't even economics, it's politics. Plus, there's the small matter of Labour's proposed tax hikes, which the CBR expects to dent short-term activity even more. Raising taxes during a time of sluggish growth? Call me a skeptic, but that doesn't scream fastest sustained growth in the G7, does it? It seems more like another exercise in kicking the can further down the road with half-baked solutions rather than genuine reform. Now, let's dive a bit deeper into recognizing the long-term institutional and structural issues hampering Britain's recovery. The pound has steadily lost value against major global currencies, and inflation remains sticky, 6.7% in late 2023. Real wages have fallen over 5% in the past 3 years, according to the Office for National Statistics, which has deepened the cost of living crisis plaguing households across the country. Britain's over-reliance on its stagnating financial services sector is another ticking time bomb. As global financial centers shift further east to places like Singapore, Hong Kong, and even increasingly Dubai, London's role as a hub of international finance is being seriously threatened. Sure, services still make up 80% of the UK economy's output, but as Europe's financial integration wanes post-Brexit, who's going to fill the gap? And speaking of Brexit, remember that? Britain's divorce from the European Union in 2020 was promised to herald an era of gleaming new trade deals and less regulatory burden, a truly global Britain. Yet here we are, 4 years later, with little to show. Trade volumes with key partners like the US and China have failed to blossom, while Europe remains the UK's largest trading partner by far. Post-Brexit Britain has yet to see any real upside, but it has certainly taken on increased red tape and market disruption in exchange for its freedom. Another one of Starmer's promises was to solve the housing crisis by ramping up construction. Yet, house prices remain volatile, largely outpacing income growth, and are forecasted to stay disproportionately high. House building remains stalled due to labor shortages and increased material costs. Consumer confidence remains low, as does buyer demand, especially as mortgage rates have surged in the aftermath of successive Bank of England rate hikes. In late 2023, the Bank of England's base rate peaked at 5.25%, pricing significant chunks of the population out of the property market. So even if Starmer succeeds in getting homes built, it does little if no one can afford them. What we need here is a government that acknowledges the challenges of affordability, not merely production. Simply building more homes, without addressing wage stagnation and spiraling costs, is like putting a band-aid on a bullet wound. It's worth noting that the incoming government hikes on corporate and wealth taxes might scare away the capital investments Labour promises to lure. Increasing top-line taxes may sound righteous when you're talking about redistributing wealth, but anyone in economics knows that capital flees from perceived risk, rather than waiting to see if the government's redistribution plans pan out. Multinational corporations are already eyeing other jurisdictions with friendlier tax regimes. Want evidence? Look at France's exodus of top companies and wealthy professionals when Macron tried a similar strategy post-COVID. There's every chance London could face a talent drain if Starmer keeps raising taxes without clear, substantial benefit to back it up. Let's not let the UK get off the hook by basking in the so-called victory of struggling peers. The Eurozone is indeed facing its share of turmoil, but we can't use the plight of France, Germany, and Italy to excuse London's failures. The Eurozone is headed towards an acute demographic crisis. An aging population, low fertility rates, and insufficient immigration have placed several key economies in jeopardy. This isn't just a crisis for Germany. France and Italy face the same pressures on their labor markets and pension systems. Seber's prediction that the UK will be 25% bigger than France by 2039 is about as reassuring as being the skinniest kid at fat camp. These numbers don't distract from the fact that real policy failures are sinking both British and European economies in tandem. Meanwhile, as Britain and the Eurozone scramble, the real battle for global economic dominance lies between the US and China. CBR expects the US to continue maintaining its spot as the largest economy while China should temporarily snatch that title by mid-century. But here's the kicker, China may win the sprint, but it could lose the marathon. Beijing is grappling with its own set of economic headwinds, chief among them, demographic decline and a rapidly aging population. And let's not gloss over their looming debt issues and opaque banking practices. If China's rise has impressed you, its equally dramatic fall might surprise you. No one sees this as clearly as the US does. America's focus has shifted dramatically, pulling away from Europe and refortifying key alliances in Asia through partners like Japan and Vietnam while securing ever-stronger trade ties directly with India. Europe and Britain need to catch up quickly, or they risk becoming economically irrelevant in a world where eastward trade dominates. The UK finds itself standing at an economic crossroads. Will its modest successes amidst failing European economies be enough to pull it forward? Keir Starmer's lofty ambitions may seem bright on the surface, but his government is constrained by the overarching realities of post-Brexit Britain, taxed to death, under competitive threat by emerging markets, with a stagnant labour market, an unaddressed housing crisis, and pivotal industries moving abroad. Real change requires more than chewing on policy soundbites or raising taxes to plug fiscal holes. What we need is strategic innovation in undervalued sectors, massive labor force realignments, investment in future industries, and maybe a little less government interference where it doesn't belong. Stay tuned, folks. We're in for a bumpy economic ride, and it's clear as day that Britain can only hope to edge out struggling counterparts by circling the drain just a little more slowly than the rest.